Hello, I am George Heber Joseph, CIO and CEO Equity at ASK Investment Managers. Welcome to our monthly market commentary, where we take a closer look at the economic and market themes shaping investor sentiment both globally and in India. It is quite an eventful month, so there is a lot to unpack. Globally, the macroeconomic picture remains cloudy. We are witnessing mounting US debt levels, a wave of credit downgrades and persistent inflation concerns. The US dollar is losing strength, and these uncertainties raising questions about the resilience of the world's largest economy. Meanwhile, the ongoing bond market turbulence, or what some call the bond versus Trump effect, is adding another layer of volatility for investors. But amid this challenging backdrop, India's story stands out. With easing inflation, expectations of further rate cuts, and a strong fiscal discipline, India is poised for a robust GDP rebound. Our key macro advantages, from a young demographic to resilient domestic demand, continue to position India as a beneficiary of the shifting global landscape. In fact, Indian markets have now surpassed pre-trade war levels, reflecting renewed investor confidence. Today, we will dive deeper into what is driving this sentiment, what the highlights from the May 2025 tell us, and how ASK is positioning portfolios to capture these emerging opportunities. Let us get started. In this update, we will explore these themes and their implications for your portfolios. Bond investors have made their feelings clear by voting against the US government's bill that introduces tax cuts and increases spending. As a result, the 30-year bond yield has shot up to 5%, which is close to a two-decade high. This is quite significant and indicates a shift in investor sentiment. Investors are worried that these tax cuts could add trillions to the already substantial US debt levels, worsening the budget deficit. It is a bit like adding fuel to the fire, isn't it? Against this backdrop, Moody's downgraded the US credit rating and further adding to the woes in the tepid auction of US Treasury. Inflation continues to remain sticky and is expected to bounce back, fueled by self-inflicted harm of tariff-led trade wars and years of money printing by the US Fed. The weakening of the US economy and inflation concerns are taking a toll on the US dollar. The global currency has been losing strength, especially since the eruption of tariff-led trade wars. The US is facing some tough times, with these mounting headwinds fanning the fears of a US recession. In this context, we believe that India and China could emerge as winners. Let's focus on India. India has several advantages, such as strong GDP growth outlook, demographic dividend, fiscal discipline with targeted capex, moderating inflation and policy room, healthy banking system, China plus one manufacturing shift which is happening, digital and financial inclusion leadership, reform momentum and policy stability, robust external sector buffers and forex reserves. This puts India on a solid footing. We believe that India is clearly the bright spot in the global economic landscape. In April, the retail inflation rate remained below the 4% mark for the third consecutive month. This is expected to ease further due to moderation in food prices. The early arrival of monsoon is expected to keep a lid on food prices. With easing inflation and a slowdown in economic growth over the last few quarters, the Indian Central Bank has ample room to cut rates. These rates give a shot in the arm to Indian economy. Additionally, the RBI has transferred record dividends worth 2.6 lakh crores to government, which could further boost spending. Income tax cuts effective from April 2025 will also contribute to this positive momentum. More importantly, India continues to walk on the path of fiscal prudence. Now let's take a quick look at the key actions from financial markets and global economic landscape over the last month. In May, the financial markets continued to recover from Trump's trade war shock, Closer to home, Nifty 50 and BSE 500 crossed their pre-tariff war marks. Key global indices like S&P 500, Nikkei and Hang Seng also moved upwards. So what's driving this recovery? The temporary trade truce between the US and China has been a significant driver. Additionally, inflation in major economies eased, fueling hopes of further rate cuts. In the commodity space, crude oil remained under pressure, which is very beneficial for India. Despite the improved global economic outlook, prices failed to rebound. The persistent concerns of oversupply from OPEC kept oil prices under pressure. Meanwhile, gold prices dipped mid-month in response to easing US-China tensions, but quickly recovered by the end of the month to reach around the US dollar 3,300 mark. The outperformer was Bitcoin, which surged to an all-time high of 108,000 US dollars. So how should the investors position themselves? With the global uncertainty at the peaks, gold has continued its rally in 2025. On the other hand, equities have been wobbly. We believe investors must take advantage of these uncertain times and invest in equities with a long-term perspective. While India's economy is at an inflection point and poised for sustained growth, the US economy seems to be at its peak. So investors must focus on Indian equities. With the Indian economy going strong, we have designed our portfolios with a sharp focus on companies with domestic-oriented businesses, inward-looking companies that could benefit from India's growing economy. On the other hand, export-oriented companies could face a double whammy of slowing US economic growth and deteriorating US dollar. Let's dive deeper. We are more positive on businesses which are domestic-focused, have less variability in earnings. Those clearly can benefit from a cyclical upturn in the economy and at the same time available at reasonably attractive valuations. In terms of the pockets that look attractive, we are constructive on private banks. Private banks are currently available at relatively attractive valuations. In fact, at 5-year trough valuations with clean balance sheets and good growth prospects. This space has witnessed heavy foreign outflows over the last couple of years, and trend seems to be reversing, led by the decent growth and potential rebound in earnings as expected. However, the impact of lower rates could be higher on private banks' profitability as compared to PSU banks. Also, PSU banks have managed to keep the credit costs under check. These factors make us positive on select PSU banks as well. As we saw earlier, that US dollar is losing strength and US economic growth is at its peak and pricing regime is still uncertain in US, this means we prefer domestic-oriented pharma companies over export-oriented ones. We are also bullish on select commodity plays as supply chain disruption triggered by trade wars and geopolitical uncertainty could keep prices elevated. However, in the commodity space, oil could be an outlier. A slowdown in global economic growth and supply from Middle East could keep oil prices under check. This could be beneficial for oil marketing companies and gas distribution companies in India. Within the manufacturing space, we like auto ancillaries for two reasons. One, auto ancillaries aren't vulnerable to changing customer brand preference. And two, regulatory changes could benefit these suppliers of components. We also like defense sector where the order flow remains strong and the visibility for the next 5 years is pretty high. This offers strong revenue visibility. Private insurance companies are gaining market share from PSUs and are beneficiaries of increasing health awareness and need for life protection and coverage, and increase in value of prices of insured products like vehicles and properties also gaining momentum. In real estate space, we prefer commercial real estate plays over residential. We believe that residential real estate prices are at their cyclical peak and may remain stagnant for foreseeable future. The supply of residential apartments also continue to remain high in metro cities like Mumbai, Delhi, Bangalore. We are bearish or negative on export-oriented sectors like IT, pharma, and export-oriented companies. A slowdown in global and US economies, subdued global discretionary spending, and weak US dollar could have an adverse impact on IT companies. For example, export-oriented automobile and pharma companies will be at disadvantage due to the deteriorating dollar and challenges in the global economies per se. For the portfolio construction, we are positive on themes like China Plus One, domestic economic upturn, Make in India or manufacturing drive, defense, India's digital infrastructure, and also the shift happening in the energy sector. I have joined ASK about a month back and is in the process of making few important changes in the investment decision-making framework. We are positioning ourselves for the next leg of growth by aligning our existing product basket to clear client need gap focused products and solutions. To support this goal, we have made few clear improvements in the investment processes and research framework, such as agility in data-driven decision-making approach, inculcating business cycles and market cap focused thinking, increased research coverage, more focused product and fund management mandates, improved risk management, more benchmark-aware strategies, enhanced technology-led support. In conclusion, India's growth story remains robust and ASK is repositioning for the next leg of growth. And we strongly recommend investing in Indian equities to capitalize on long-term wealth creation opportunities. Thank you and see you next month.